Soft US data has lifted bets for Fed rate cuts this year, ahead of May's PCE inflation print today. There's good news on inflation pressures in New Zealand, and the Philippines Central Bank holds rates but looks to pull its easing cycle forwards. That's coming up in our 5 Things in 5 Minutes. And then in part 2 of a bonus deep dive interview, ANZ Chief Economist for Greater China Raymond Yeung explains why China is so focused on gaining monetary policy independence through de-dollarization.
The Chinese government has been pushing for the renminbi to become a global reserve currency. And from this perspective, then your central bank can more easily to expand your balance sheets and to provide some quantitative support.
But first in 5 and 5 with ANZ. I'm Alex Tarrant, standing in for Bernard Hickey, who's been on a midwinter break this week. US Treasury yields are down and stocks up slightly on rising hopes the US Fed can cut rates from September. Final US Q1 GDP saw private consumption growth revised down, while core durable goods orders fell in May. ANZ Head of G3 Economics Brian Martin says that points to softer spending ahead of May core PCE data tonight. That's the Fed's preferred inflation measure. Brian is expecting a monthly core print of 0.1% at a flat headline rate, which would indicate a gradual resumption in disinflation.
I think this is just underpinning the slow approach from the FOMC towards moving to ease monetary policy at some stage in the future. They still want to build greater confidence that inflation is on a sustainable track down to 2%. I think the May PCE data will certainly help towards that, but I don't think it's going to be sufficient. And I think we're going to need to see another round of soft inflation prints for June, which will be published in July, if the Fed is to really start to build its confidence that they are on track to return inflation to target over their forecast horizon.
The US dollar index was also down about 0.2%. The Aussie was up 0.05% at 66.49 US cents at 4 a.m. Sydney Melbourne time, while the Kiwi was up 0.12% at 60.89. Number 2. The Philippines Central Bank held rates at 6.5% yesterday, as expected. ANZ economist Arundam Chakraborty says the key news was the BSP reducing its inflation forecasts, potentially bringing its easing cycle forward.
The central bank believes that it may be able to start cutting the policy rate in August with cumulative cuts of 50 basis points this year. We, however, do not anticipate a rate cut this year. Although both inflation and trade deficit are showing signs of improvement, they are still at levels that warrant policy restrictiveness. Cutting its policy rate ahead of the US Fed, or even in perfect lockstep, can exert depreciation pressure on its currency.
Number 3. Good news on New Zealand's inflation fighting front. The ANZ Business Outlook Index fell again in June, with a large fall in pricing intentions. Here's ANZ New Zealand Chief Economist Sharon Zollner.
Encouragingly for the Reserve Bank, we saw a pretty good fall in both the proportion of firms who say they're going to raise their prices and the amount by which they say they're going to raise their prices over the next 3 months. Costs are still sticky. We have seen progress there, but less. So there is probably a bit of margin squeeze going on, but that is part of the recipe for the Reserve Bank in getting inflation lower. And the good news is it's working. So we think the Reserve Bank will be able to cut the OCR sooner than they expect.
Number 4. Sharon says New Zealand consumers were also more wary. ANZ Roy Morgan consumer confidence dipped again in June.
It's at 83, so the 20-year average for that series is 114. So we're off the lows that we saw when inflation was at its worst. That was definitely having a dampening effect on confidence, and confidence was in fact recovering as inflation was falling. But then 3 months ago we had those recession headlines that really hit confidence hard, and essentially we really haven't seen much of a bounce back since then.
Number 5. Australian job vacancies fell 2.7% in the 3 months to May, to be down over 17% annually. ANZ senior economist Blair Chapman says vacancies are still elevated compared to pre-COVID levels.
Businesses might just be keeping vacancies open with a little bit of hesitancy to pull them back because they have been having trouble finding staff over the last year or so, and so maybe just keeping a vacancy up constantly is just the way they're thinking about the labour market at the moment. So might just be keeping it elevated for a little while, but as businesses become more confident that they'll be able to find staff in a timely fashion, I think we'll start to see those vacancies fall even more.
Blair Chapman there. Now, in part 2 of a bonus deep dive interview on China's de-dollarization, ANZ Chief Economist for Greater China Raymond Yeung outlines why Chinese authorities are so focused on greater monetary independence.
One of the reasons why central banks want to promote their own currencies for external transactions, not only about China, but many Asian countries, including Japan, have been trying to do that in the past, is because they only if you can use the local currency, then you will gain a lot more monetary policy independency. For example, if your external trade are still largely US dollar denominated, then you'll be carrying, how much US dollar on hand to fund your imports. And also in terms of how you deal with the exchange rate volatility, it is a lot more headache with a global volatility that will affect your trade, because if they are denominated in foreign currency or US dollar, then you really need to deal with the exchange rate risk. Now, if you are using your local currency, or if China is using the renminbi exchange rate, now obviously that will also be with any change in the global foreign exchange market will still be reflected in the foreign exchange rate. But since your settlement currency will be in local currency, though the adjustment process of the international price will be down to your local domestic price. And from this perspective, it will give a lot more freedom, at least in the short term, for the central banks to change your interest rate, because many central banks, or in fact most central banks in the world, using interest rate to manage their macroeconomic conditions. So interest rate will still be the preferred tool. But if your currency or your trade and external transactions are highly sensitive to exchange rate, then that might be an additional consideration for the government to think about, if I cut my interest rate to boost the economy, would that result in a weakening of my currency? If you're using the local currency to do your trade, at least in the short term, you will be free of peace of mind, in terms of how you can manage or use your exchange rate to manage your cyclical growth momentum for the domestic economy. So by using more local currencies, very more easy for central bank to gain the interest rate authority. And at the same time, if your currency is widely accepted globally as a global reserve currency, such as what the Chinese government has been pushing for the renminbi to become a global reserve currency, and from this perspective, then your central bank can also more easy to expand your balance sheets and to provide some quantitative support or quantitative easing to support the local economy. That's exactly what the US has been doing in the past few decades. And so this could also be a consideration for the Chinese authority to promote the renminbi as a global reserve currency.
And so you see the de-dollarization continuing?
I think from the current economic backdrop, the Chinese authority will quicken this process in the next few years, especially that we know now the People's Bank of China would start to consider, or at least explore, trading the local government bonds. By the terms of local, I mean the Chinese government bond, and bring it to the balance sheets and be part of the support to the domestic economy. And by doing that, that's actually opened the door for quantitative easing. If this is the case, then having the renminbi as an international reserve currency will be very important for financial stability.
Raymond Yeung there. I'm Alex Tarrant, standing in for Bernard Hickey. That was 5 and 5 with ANZ for Friday, June the 28th. Happy Matariki to our New Zealand listeners. Catch you next week with key data on the state of the US labour market.
This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.